We honestly wish I had known about this years ago. Basically, this is a strategy that wealthy individuals, but I think even not so wealthy individuals could really leverage the strategy. If you're buying something that's not really growing, then that's probably not a good idea for the strategy. There's so many different AI companies out there offering all kinds of agentic AI services and charges. Like you can pay a certain amount per month to have access to all these AI agents. Those I think are a bit more at risk compared to the infrastructure companies, because infrastructure companies, they could just provide that infrastructure to another AI platform. Now you have these huge data centers that are like, over a gigawatt in scale. The real question is, where does the power come from? AI didn't care about that. However, Bitcoin mining companies had access to all these purchase power agreements with all these utilities around the country and around the world, but they have access to this affordable power. Most of the traditional cryptocurrencies like Bitcoin, Ethereum, and so on, they're not going to be treated as securities.
Welcome back to Global Mining Talk. Joining us today is Josh Lee, the former head of Google X for Asia Pacific, where he worked on moonshot technologies in energy and telecommunications. He was the chief operating officer at ROX, a crypto exchange and DeFi cross-border payments company, and a senior director at Mara Holdings, where he led the business for advanced data center infrastructure cooling. We examined Josh's strategy of borrowing against rather than selling appreciating financial assets to prevent large tax liability and maintain principal growth. We discuss who might come out as the winner between the large AI companies and the hyperscalers. We also look at power and cooling, which are becoming the biggest challenges for AI, as well as national sovereignty over the AI product. Finally, we tackle how the world is moving into tokenizing real-world assets given recent decisions by the Fed and the SEC. Let's dive into our conversation with Josh Lee. Josh, welcome to the show. We have so much to talk about.
Yes, Ty, thank you so much for inviting me. I'm excited.
Really excited to have you here. So one thing that that you've spoken about in the past that's really I find really interesting is you said that one of your biggest mistakes was selling Google stock. I think might have been to buy a house, and you said instead you should follow. Investors should consider following a strategy of buy, borrow, and die. Can you talk a little bit about that?
Yeah, happy to. Yeah, I came upon this last year, and I honestly wish I had known about this years ago. So basically, this is a strategy that wealthy individuals, but I think, as we'll discuss, even not so wealthy individuals could really leverage this strategy. So basically, the idea is that instead of selling appreciated assets to fund a down payment for a house or to pay for a very large expense like kids' education potentially, you borrow against your appreciating assets. Okay, so there's really three main pillars. There's the buy, borrow, and die. Because I'm going to dive into each of these a little bit more. Sure. So buy is to acquire appreciating assets. So a very important thing is that like you have to buy things that are appreciating, right? So traditionally, a balanced stock portfolio, ETFs, or a real estate that is generating healthy cash flows. Those are counts as assets that would suit well into this buy, borrow, die strategy. If you're buying something that's not really growing, then that's probably not a good idea for the strategy. And so that's the buy part, or you already have it. You already have that. The second part is the borrow part, right? And so this is where, so instead of selling the asset, because when you sell an appreciating asset, there's capital gains tax, which you have to pay, right? And I actually had a surprise bill when I sold my Google shares. Now, if I borrow against it, I never have a sale, so I never realize any capital gains. And I could borrow against that. So certain financial institutions will allow you to do a securities-backed line of credit. So in essence, your security is serving as a collateral for this loan, and you get a certain interest rate. And the key is that you have to make sure that your assets are appreciating at a higher rate of return compared to the interest you're paying. Okay, so that's the borrow part. And then the last part is the die part. So honestly, when anybody passes away, one of the wonderful things about the tax code as of now is that your children or your heirs will inherit the assets, but with a step up in basis point value. So it means that, let's say if you bought a stock at $100, and when you die, it goes to $300, they inherit that $300 basis as opposed to the $100. So they basically, all that capital gain is kind of not counted, right? So that's a wonderful gift to your heirs, is to basically pass on appreciated assets. So that's kind of like the buy, borrow, die strategy in a nutshell.
So if I want to drill a little bit deeper in this. So it makes sense that you want to make sure that these assets are already appreciated so much that if you sold them, you would incur a huge capital gains tax, which you don't really want to pay. I mean, even that's 20% of potentially a very large number if you've held it over a year. And then if you've held it over a year, and then you want to make sure that they're growing faster than your interest rate, which also makes sense. Now, what kind of, because you're using in this case, Google stock or something that's, as collateral, what kind of interest rates would somebody who, somebody who is, doing the strategy, what can they expect to pay roughly?
Yeah. Yeah, it's a great question. So when I started looking into this, and by the way, this was a caveat that everything we discuss is not financial advice. People should consult with their financial advisors for
Absolutely.
everything, right? It's just kind of like sharing my own personal example of what happened. So once I heard about the idea, I started to look into it. So Charles Schwab does offer securities backed line of credit. So does Fidelity. But I found that the amounts that you have to put in as a minimum was a lot higher, and the interest rate that I had to pay was higher. I ultimately, what some of the other YouTube influencers where I learned about the idea, they used M1 Finance, which is it's kind of like a Robinhood. So basically allows you to buy and trade stocks and ETFs. You have both of the online website as well as a mobile app that allows you to do it. And they basically offer security backed line of credit. And my interest rate was 5.65% a year. But when I joined, they had a special promotion. So for this whole year, I get a 4.15%. So and that literally is, I'm paying that when I borrow to against my securities to buy additional stocks or ETFs. Or if I wanted to now, if I fund any major purchases, I could just borrow against my existing portfolio. And so I think that you have to kind of shop around, right? If you already have a lot of your portfolio with Fidelity or Schwab, maybe it makes sense just to borrow from them, but there's probably other lenders out there.
Right, but it makes a lot of sense if you have really appreciated asset that you actually want to keep because you think it's going higher. You don't want to basically cut your principal down so less of it grows. So this sounds like if you borrow against your stock and there's always a chance, at least in the short term, that the stock depreciates, then you potentially have a margin call, right? So how much of, what percentage of the asset that you put, let's say you put up $1 million of Google stock, how much should you draw down against that just to be sort of safe and not get a really, really large margin call?
Yeah, that's a great question. So the honest truth is really depends on your appetite for risk and also the specific underlying assets. So I know that M1 will kind of put and say like if you have stock versus ETFs versus a certain type of ETFs, they'll say, okay, here's the amount of collateral needed, right? So for Google shares, it's 25%. So if I have $1 million, that means that I have to have $250,000 of Google shares. And if I get below that, that's when there's a margin call, right? For certain ETFs that are, a little bit, pretty relatively safe, maybe it could be 30%, right? For I have some ETFs that's a little bit more aggressive. Maybe its requirement is 40% or 50%. So for every single asset, it'll tell you what is the amount of collateral necessary. Now, as a general rule, I try to make sure that my overall portfolio, my loan to value (LTV) ratio, doesn't go below 60%. So basically, I'm borrowing up to 40% of the total loan portfolio at any given time. And but definitely you don't want to really go much more below 50%, because then because of the stock market ups and downs, there might be a higher risk. But it's really up to each individual investor to really weigh his or her risk profile.
So it's really a relatively conservative way of approaching it, where you don't really certainly max out your line. You do enough to as you say, make a down payment on a house or pay for college. In the U.S., of course, we know how much we have to pay for colleges, and it's a big number. It's a big number. So that's a very good point. I think this is something a lot of people don't think about. They say, well, I'll sell some stock, but if you sell some stock, you're giving up potentially a lot of appreciation. Um,
Yeah, yeah, exactly.
I want to move a little bit into, sort of the tension between, sort of AI companies and the hyperscalers. AI companies meaning Anthropic, OpenAI, biggest players in the field versus the Googles and Amazons of the Metas of the world, which are really the biggest customers of this product. How do you see that competition playing out? I see that OpenAI when I say OpenAI or Anthropic has contracted to buy hundreds of billions of dollars of chips to be able to supply this compute to a lot of the hyperscalers. Will there be an issue where if they can't pay it back, then the hyperscalers end up being the AI companies?
Yeah, it's a great question. So obviously, I'm going to start prefacing, and I was, 12 years at Google, so I'm definitely pretty biased, for Google. I think that, Google it kind of is in both camps, right? So basically, not only does it have, amazing ads business, amazing cloud business, YouTube, you name it, but it has infrastructure, right? And that's what is at the end of the day, companies who are supplying infrastructure like Nvidia, people supplying the data centers, they're going to be the ones supplying that raw compute power to the companies that need that compute power. And then but at the same time, it has these amazing AI platforms like Gemini, like Nano Banana, like Vio, and all the other stuff. So it's competing also directly against OpenAI and Anthropic and so on. Now, I do think that in the future, there's going to be a little bit of a shakeout. And so if you're there's so many different AI companies out there offering all kinds of agentic AI services and charges. Like you can pay, a certain amount, $20 to $200 or $100 per month to have access to all these AI agents. Those I think are a little bit more at risk compared to the infrastructure companies, because infrastructure companies, they could just provide that infrastructure to another AI platform. But I do think over time there's going to be a convergence of the two, meaning that, and actually, since our last call, I was thinking a little bit about the analogy. Remember how back in our days, AOL kind of bought over Time Warner, right?
Sure.
That was kind of like an analogy. I kind of thought that at some point in the future, there are going to be mergers between companies that are kind of in adjacent space, but kind of it could be like a micro. I mean, Microsoft already invested right in AI companies, so you're going to have a lot more mergers and acquisitions, a lot more synergy. But everyone's going to say, okay, how do we make sure that we can provide not just the AI services, but we also own the AI infrastructure, because that didn't allow us to really reduce the cost. And that's why I think Google has a tremendous advantage, because it has building its own set of very advanced servers to provide AI inference at a much lower cost compared to its competitors.
So for someone like Google, there was some concern that their search function and where they drive a lot of their revenue, not all of it, but a very big chunk of their revenue, could be taken over by these AI companies. So I guess the example is, why search for something on Google where you can ask AI to do the same thing for you, and they do a much better job. But then Google's come up with Gemini. The last Gemini release, at least I recall, seemed to have done very well and did wonders for the stock. Is eventually Google going to be a competitor to an OpenAI or an Anthropic? Will they be clients? Will there be a mixture of the two? How will that work?
Yeah. So, Google has always been a competition and also a partner with a lot of companies, right? So way back then, I still remember when I was at Google, we kind of saw Apple as a big competitor, but now, Apple is one of the most strategic partners for Google, because, Apple's going to be embedding a Gemini into a bunch of its services. It's going to be, really, and I was reading recently, Apple hardware could really enable agentic AI and so on. So I think in some ways, yes, it competes with Anthropic, competes with OpenAI, but when on the ad side, the ad business, they just basically want people who are going to be advertising, right? But when it comes to specific things like Gemini is going to compete with, I think, OpenAI and Anthropic. But then Google also has the whole data center infrastructure piece. So whoever are the companies that really need that compute will then also be customers as well, right? So I think it's, yes, Google is basically a lot of different industries, and it competes in many ways with many of its customers and partners.
You've written and you've written and talked about some really interesting things about power and cooling of data centers in terms of how powering your, I guess, two-part question in terms of how power is really important, how you're going to get the power there, and then how efficient you are to use that power, and also at the end of the day, you're producing so much heat out of these data centers, you need special forms of cooling. Can you talk about power and then cooling?
Yeah. So, I think that data centers started to really boom over the last like 10 years, but the last few years really has accelerated even further. Now you have these, huge data centers that are like, 700 megawatts to, over a gigawatt in scale. And then the real question is, where does the power come from, right? And now, one of the things that AI, because the demand is so hot, they initially don't care as much about the cost of that power. So, with the Bitcoin mining industry, where I worked on, the cost was super important. To mine Bitcoin efficiently, you have to get to a cost of a cents per kilowatt. That's kind of like on the order of, like, let's say 5 cents, right? If you're above 5 cents, it's probably not economically good for the long term. If you're below that, then that's a competitive advantage. AI didn't care about that. However, the Bitcoin mining companies had access all these purchase power agreements with all these utilities around the country and around the world, where they have access to this affordable power. And these AI data centers take a huge amount of power. So the question is, and it's actually about backlash too, because what happens is the local community, when the data center is competing for that power, the local grid operator will sometimes raise prices for the residents in that area, that state or the county. And so there's a lot of backlash, right? So I think the Trump administration recently basically said, if you bring your own power, right, you're more likely to get approval to move forward. So power is one of the key necessities of modern data center. The other is water, right? Because a traditional data center that's air cooled requires a huge amount of water for this cooling. Now, the latest Nvidia set of GPUs and servers, everything's moving to liquid cooling. And so with liquid cooling, definitely more efficient. And also, in certain models, you still require a lot of water, but in certain models where you can have a closed loop water cooling, then you don't require huge amounts of water. So more modern data centers that are moving away from air cooling to liquid cooling have the ability to actually reduce the amount of water needed. And because it's more efficient, it also reduces the amount of power needed. So that's why there's a huge set of very advanced technological developments in the data center industry.
I want to talk about the power a little bit. How easy is it for a big data center, a gigawatt? I mean, how many homes does a gigawatt produce power up? 750,000. I can't even remember.
Yeah, I can't remember the
many,
number,
many
it's a pretty
thousands of
large
homes.
number. Yeah.
Many, many thousands of homes, right? How are these data center developers been successful in bringing their own power? I mean, understand ideally you have your own little nuclear reactor sitting by that, but we're not so nuclear friendly. I think we are more than we used to be, but we're not that friendly yet. Are they having much success bringing in their own power?
Well, I think that's definitely one of the key, latest trends, right? So that's why you hear about, Google, Meta, all exploring, small nuclear reactors. You hear about interest in, like natural gas. Or one of the things that, my former company was looking into was stranded energy. So these oil wells that were stranded, and you can basically, and that's actually, this is actually also very environmental, where traditional oil wells, a lot of the methane that gets that process of drilling in those oil wells have to be flared, because EPA says we don't want the methane to go in the air; it has to be burned. Now, if you actually just attach that methane to a way to actually basically burn that, you generate electricity from that. And then attached to that isolated oil well, you could have a modular data center mining Bitcoin, let's say. Right now, if that was a little bit closer to where you could connect that to internet access, you could actually build a modular data center right there as well. So that's why there's a very strong convergence of energy as well as data center development.
I mean, that makes a lot of sense because you've seen, especially if you've driven around in Texas, you see all this stuff burning in the air, and you're like, this can't be good. And if you could use it for a better, a better way, it makes a lot of sense. Just for the cooling part, so I understand that using water is much more efficient cooling than air, but how does that actually work? You certainly don't soak the chips in water. How would you use water to cool instead of air? Like, just technically.
Yeah. So liquid cooling, there's really three main types. There's what's called direct to chip, DTC, or direct liquid cooling, DLC. Then there's single immersion, and there's two-phase immersion. Okay, so I'm going to kind of walk through the three different kinds. Now, the direct to chip, where they basically put this manifold on top of the CPU and or GPU, and in a server, those are the two components that get the most heated, right? And now with the density of the really advanced, Nvidia, Blackwell's, Rubin, GPUs, they get very, very hot. So air cooling is just very hard to just blow cold enough air past that. So it requires liquid cooling. So the traditional way right now for liquid cooling is putting a manifold on top of just the GPU and CPU, and then liquid flows through it. And one form of liquid, that's the more dominant current one, is actually water. Now, the only problem with that is that water, if it actually is a leak, it will actually potentially damage very expensive server componentry and stuff like that. So you have to really watch out for water. However, you could actually use different type of fluid, and so there are fluid that's either single phase cooling fluid or two phase cooling fluid. These are different type of fluorochemicals or different kind of chemicals that have really advanced properties that provide the cooling, but it doesn't corrode the electronics. Okay, but then has its own set of engineering challenges that need to be worked out.
Fascinating.
Single phase immersion is where you put the whole server into a specific type of fluid, which is a oil-based like fluid, and that whole server is all cooled by it. And the server components have to be designed to not react with that specific type of fluid. And this single phase immersion, I think, is well understood among Bitcoin mining companies, Bitcoin mining ASIC servers, and even among AI servers. I think that industry is already relatively well known. Definitely some pros and cons compared to direct liquid cooling, but I would say that mechanics is probably well known. Then the final type is two-phase immersion cooling, where it's a different type of fluid. It looks like water, but it's actually not water. And it actually boils at a certain temperature, for example, around 60 degrees Celsius. And the act of boiling something requires a huge amount of energy. So that then cools the server down very rapidly. And it boils into gas. It gets condensed by a set of, like a closed water cooling loop that then converts that gas back down to liquid inside the chamber. And that cools the whole mechanism. So again, there are pros and cons to two-phase immersion cooling, and but I'm a believer that one of these phases, one of these types of liquid cooling will continue to get better and better and better, and at some point, more and more advanced data centers will be using some form of liquid cooling.
So are we close to a wall yet, where like a quote unquote wall? If you're not using liquid cooling, these things are just going to be too hot to work efficiently?
Yeah, so I think Nvidia pretty much already announced it. I think that definitely, the last week was the Nvidia GTC conference. Their latest version called Vera Rubin architecture. It's fully liquid cooled. There's really no option for air cooling at this point, right? So I think we're already at that level of compute density where it's so advanced, and that's running so hot, it's not possible to cool the GPUs and CPUs. So it has to be liquid cooled. Now the question really is on all the other components in the server, like the memory, like all these other things inside the server. Now, even if you cool with a liquid cooling, the CPU and GPU, there's a kind of like a thing that mounts on top of it, and the water's flowing through it. But what about all the other components? Those started getting very hot as well because they're getting more advanced. So that's why at some point you may have to have like move to the single phase or two phase immersion cooling where the whole server is in a specific fluid. But that I think will still take a few more years and cycles before all the other components get hot enough that they all need to be liquid cooled.
Are there any publicly traded companies that are really like big into cooling that investors could look at or should be looking at?
Yeah, again, this is not financial investment advice, but I think one company that is, two companies that come to mind. One's Vertiv, and the other is Snyder Electric. But there are a lot of companies that are like constantly, buying companies in this area. There are companies that make specific components that like Boyd and Coolmaster. They make specific components. Then there are like even more. They're definitely not public companies like Zutacore, Excelsius. These are companies that are making specific component to facilitate, this advanced cooling technology.
Excellent, excellent. Something definitely to look at. One of the things that you've talked about is sort of compute efficiency in terms of who's the like a car. Do you have an old Detroit gas guzzler, or do you have like a nice Toyota or Honda that's really efficient, or perhaps even electric vehicles? In between the models, the biggest models, I guess, Anthropic's Claude or Perplexity or ChatGPT or perhaps even Gemini, are there big differences in sort of compute efficiency?
That's a good question. I don't know. I'm definitely not an expert on the efficiency from the specific models, but my guess is that the later models will be more efficient compared to older models because they now have a larger context and there's different ways. I was doing some research over the weekend on Nemo Claw and then about the different compute costs, and there's definitely like shortcuts that developers could use to cache certain portions of what you want to do in certain forms of memory so that you don't necessarily have to be paying for a lot of tokens, constantly. You basically can have a bunch of shortcuts to do it. So I think it's but I don't know if that's necessarily model specific versus just, developers, with the help of AI agents, giving them advice on how to minimize the use of tokens to achieve a certain task by putting certain things to certain memory or storing certain things in certain files and so on.
Now let's move to a question that everybody here is interested in. All my viewers in Korea are very interested in. What jobs is AI going to take, and the harder one, of course, is what jobs will it create? What do you think? Big people are really concerned about this.
Yeah, really good question. So, definitely I have kids who are, want to be coming to the workforce, in a couple of years. So I'm also thinking about that. So my understanding is that recently there was a lot of research where they looked at a bunch of jobs and they said, okay, what can AI realistically replace? And so now, don't want to scare people because at the macro level, I still think that more jobs will be created in the future compared to the jobs that are taken. But there's going to be a lot of restructuring and changes in between. But anything that is a white collar job where you are literally sitting in front of the computer for most of your day, and all you are doing is reading stuff and then typing stuff into the computer. Okay, if that's your main job, then I would say, really think about, you better be the ones who are able to train the AI or use the AI as a virtual colleague or a virtual employee of yours. You are the manager managing a team of AI agents to, whether it's to analyze something, whether it's to create a spreadsheet of something. If you are the one managing the set of AI agents, then you'll be okay. But if you're the one who are directly creating a financial report, let's say, right? And you are not really leveraging AI very much, then AI could probably do that better than you can, right? At a fraction of the cost. So all white collar jobs where you are literally just sitting in front of a computer, looking at stuff, writing stuff on your own, those are the biggest jobs that's affected. Anything that revolves working with your hands are ones that are very safe for now until humanoid robots can really do the same. So, and because of the AI data center boom, electricians are like hugely in demand. People know HVAC cooling technologies. Like, in our last role, when we had to hire electricians and plumbers, I mean, those folks commanded, hundreds and hundreds of dollars an hour, and we had to beg them to come to our site to work on stuff, right? So I think that people who work their hands, and then even on the side of where you're not working with your hands, but if you're creating something creative, right? Yes, although you can have AI generate art, you can have AI generate music, but if you but those are things, the quality of those creatives are not really there. So if you are able to just be very original, create new things, or focus on developing things for entertaining people, that's humorous, that's kind of like inspirational. I think those fields will still be definitely necessary.
But sort of the white collar worker, specifically as we have gotten used to it, 70% of the economy is services. There, it remains to be seen how some of those people are going to be replaced. We just don't know yet.
Yeah, I'll give you two specific data points. So, I know that when Anthropic recently launched a new version that's very focused on the legal industry, right? A lot of legal industry stock kind of went down because, in essence, it probably does a pretty good job of being a paralegal, right? And even like a lot of the work that like an entry level lawyer would do. Now, however, you still need more senior lawyers who are able to understand, how to give direction, but it just reduces the total number of headcount, and it's puzzling that society has to figure out how do you then get to more senior level roles without people having to go through entry level roles, right? But legal industry is one. Another recently is Google launched Stitch, which is kind of like a replacement to Figma, or competes against Figma. Figma was a tool that a lot of graphic designers were using to design things for websites. It could be graphic artists designing all kinds of logos and everything. And Stitch allows now like a non-technical person to just using words describe what they want, and you can generate a pretty good outcome, right? So now, for being a graphic designer or somebody in the design industry, you're going to have to really step up. And maybe the number of jobs in that industry also will be impacted. But then the ones who are truly creative, who know how to give direction, it's almost like an art director. Art director at an ad agency has the vision of what to set the junior people to work on. So I think that kind of art direction, high level creativity skills will be necessary, but the junior level kind of executing the actual work will be delegated to a mixture of people and agents.
Interesting. Last but certainly not least, you've discussed something you call the $10 trillion war, and that's economic sovereignty. Basically, you have to have sovereignty in the compute that you're using needs to be basically in your country. So I suppose the U.S. compute wants to be housed, on literally in the U.S., whereas China would want their compute in China, and so on and so forth. But not everybody can, I guess. A lot of the more advanced countries can have their own. But how is that going to play out in terms of? Will it be only a U.S. based U.S. based compute, European based compute, China based compute? Who's in the race, and who's going to win, and then what is everyone else going to do?
Yeah, it's a great question. So even I remember back in my days at Google, a long time ago, as head of Google Enterprise for Asia Pacific, there are some customers that wanted to make sure that their data resided in Asia, or certain specific countries in Asia, and at that point in time, they that movement of sovereign AI didn't really take the hold that it is today, where I think Google was able to say, well, we have these certain data centers in Asia Pacific, and that was relatively good enough for the potential customers. But I think these days, driving this sovereign AI is really the governments themselves. Certain countries, they might be a U.S. ally, but they also are a little bit worried about some very sensitive data, especially if the end customer are government agencies in those countries, right? They don't want that data to sit outside their own borders, because who knows what will happen with the geopolitics of the world. Someday in the future, somebody may get access to that you don't want that to be there. So certain use cases, anything government related, they might want that data to reside in their own country. Now, large enough countries will either mandate that their government ministers and departments use data centers built in their own country, and they'll have enough clout where they could either co-invest in a company to build data centers in their country. So I'm thinking like Malaysia, Indonesia, India, Philippines. They're relatively large enough that the governments will probably, get their wishes. But the other trend that my colleagues and I believe is these things called modular data centers, where there's a big difference between AI training and AI inference. AI training is where you have like the Anthropic, OpenAI, Gemini, building this very large language model that requires huge context window. Training that model requires a massive data center. But the AI inference, which is the application of a specific end user query or set of instructions for an agent, that's AI inference. AI inference actually cares more about low latency. So you could have that AI inference done at a modular data center close to the user. And that means that imagine this world where you still have these mega data centers supported in certain parts of the world, but now you also have a mix of smaller modular data center all around. And so some of those smaller modular data centers may be housed in like Malaysia, Indonesia, Philippines, and so on. And then the government just have to make sure that their data resides in those specific, data centers within their own borders.
I see. So the big the big training nodes will be wherever the big guys want to build them, but then it'll be the inference can be much more distributed, and then everybody can have at least their sensitive stuff, in their own country. That makes a lot of sense. I want to switch tacks now. You've done a lot of work and a lot of research in sort of market infrastructure changes, the RWA, or real world asset tokenization. And last week you actually posted a video that you said that the Fed flipped the switch, and it was a big deal for the market. Can you elaborate on that?
Yeah. So basically, I would say this trend has really picked up pace quite a bit since Trump administration came in. Before that, just kind of remind everybody, we had crypto winter, we had the Biden administration really being antagonistic towards the crypto industry. But now, basically, you have much friendlier set of administrators. So anywhere from the Fed, anywhere from the SEC, which also announced something major last week. There's a new, it's a new chairman for the SEC. So basically, the idea is that we want to really treat crypto not as like a completely separate asset class that's kind of separate rules that's a lot more onerous. Let's kind of treat them as so when we passed the Genius Act last year, and this year, now the Clarity Act is getting hashed out. But the idea is to really allow stable coins as a way to have yield, and then also people could invest in that, having same sense of surety that the government have a bunch of oversight on it. And the major SEC announcement last week was that most of the traditional, what we consider cryptocurrencies like Bitcoin, Ethereum, and so on, they're not going to be treated as securities, which has a very specific set of rules on how they could be marketed and sold. As a non-security, they're more like a commodity, so they're much more easily bought and sold. And the SEC also allowed NASDAQ to work with Kraken to really do some pilot testing where they could tokenize U.S. stock that would then really bring about 24/7 stock trading. Like I think even like Robinhood a few months ago, they launched Tokenization, where their customers in Europe could basically trade tokenized stock in Europe. So I think that the latest regulatory changes in the U.S. is really moving towards thinking of crypto not as a completely separate thing, but more as a different form of traditional stock or assets, and try to really bring about the merger of traditional finance with decentralized finance or the Web3 kind of world. So I think this is tremendous developments.
So I'm curious. So the SEC said that you can, I think it was tokenized stocks are going to have the same rights and as regular stock, basically the same thing. If the Nasdaq were to support this, it would stand to reason that it's still on exchange because that's how they make their money, but it's tokenized. So would it be fair to say that it would be tokenized trading but on exchange? Is that correct?
Yeah, so I think that my understanding is that it's like traditional stock. There's like DTC, so there's a clearinghouse. So let's say when people buy and sell stock, actually, like hundreds of years ago, physical, stock had to go physically be sent to whoever bought and sold it. So that took a long time, right? Then, like a more recent innovation is you have one company that basically has this massive ledger that keeps track of all the different stock purchased and sold, and they kind of have different broker dealers having a ledger that basically netted out the transactions. So they kept track of that in a ledger that was not blockchain based. Now, moving to a world where everything is tokenized and the ownership of the token demonstrates your proof that you own the shares. So now instead of a T+2 settlement, it's like nearly instantaneous settlement, right? So then you could then make certain decisions faster. You could buy and sell things faster. You can potentially arbitrage better. So I think it's a completely different way of thinking about it. At the end of the day, when you before this announcement, when you bought and sold stock, you never physically got any piece of paper or anything like that. It just in some database somewhere it had your name on it, and it kind of everything netted out. But now, it might still be held at the broker dealer level, but certain tokens. But at least you basically, and it's possible that you have your own wallet. You actually have those tokens that you could actually do something with it. But it's definitely going to be a lot faster.
It's a question. I mean, certainly the fast settlement is great. Instead of 2-day settlement, you can have instantaneous settlement, and potentially you could have instantaneous trading as well.
Yeah, that's exactly the trend, right? So I was also just reading today that there's a decentralized finance company called Hyperliquid. Hyperliquid is one of the largest ones, and they trade these things called perpetual futures or perps. And one of the biggest trends from last week was that oil trading perps, right, perpetual futures have really skyrocketed, is because they wanted to have this 24/7 trading. So with all the volatility going on in the Middle East with the Strait of Hormuz, like today's world, things move just too quickly in the after trading hours and on weekends. And so having everything tokenized means that it is literally 24/7, 365 days a year, constant trading. And that's when investors could adjust to whatever news happens around the world.
So one question I would say, and as a former trader, is 24/7 trading actually a good thing? I like it for crypto because that actually tells me sort of what the market is feeling. But sometimes the weekend is a good buffer in terms of, I think part of the reaction when the current conflict with Iran started, it happened on a Friday night, Saturday morning. The market had almost 2 days to really think about it. Is it good to have some kind of buffer where the market isn't on all the time?
Yeah, I think honestly, you know that better than I do in terms of market psychology and whether having 24/7 is a good thing from the psychology of the market, and or just knowing that you have the ability to do it. I think that to trade 24/7 gives people a sense like, oh, right now I have, so it's like a bank run, right? If I know that I can't do it, then Monday morning there's a massive pressure like that then actually then causes a ripple effect. Whereas like now, if I actually have 24/7, I don't feel there's a need to do a bank run. I can monitor things throughout the weekend, and then you can see different sentiments throughout the weekend. You have buying and selling, and then you have people in the news saying different things, and then it's more gradual, right? And there are going to be very influential people who even if there is 24/7 trading, they're not going to really think about it until Monday morning anyway. So you're still going to get an uptick in activity, but that weekend activity will then actually take some of the steam pressure building from the overall market, right? But you're kind of like the expert. I have no idea. That's kind of just my impression.
I don't know if I qualify as an expert, but there is a good point in terms of, if nothing opens until even if the futures or stocks are, till Sunday night, New York time, or Monday morning, you've created a lot of pressure. If you could release some of that pressure, that would actually be a good thing. And there's a point to be said about that. I think the exchanges are probably going to set some of the rules simply because sometimes you have to have an upgrade. You really don't want to upgrade certain things while the market is open. That can lead
Yeah.
to very, very, very bad results.
Yeah.
But it really, is a big change for the market. I have a question for you. So right now in the U.S., there's a lot of issues with private credit, and it wouldn't surprise me that we'll see that in some of the other advanced economies as well. I think we're the biggest user, but we're probably not the only one. Should we be tokenizing things like private credit in one hand, sort of democratizing it a little bit and letting more people look at it and see it real time? Would that be a good thing?
Yeah, I think that because I still remember my philosophy class back in high school where, we talk about truth kind of reveals things, right? So I think sometimes when you have more transparency, so then, and I do believe, even though the market's not, 100% efficient, but there is definitely efficiency if certain things are brought to light. And so right now, like let's say if you have a private credit where nobody knows about it except for the parties involved, then you don't have as much signal to the rest on exactly how do you price these things accurately. But if you actually have a mechanism of tokenizing the private credit, then that democratizes investments. You're giving more investors a chance to participate in that private credit, as well as now you have a much more of a market and of forces at play to value those things more accurately. Just as prediction markets, right? Like, you can argue that like, yes, it has its cons, but one of the pros is that, generally the wisdom of crowds, has some pretty good predictive powers. And so, yeah, having private credit tokenized would allow more people to participate in it and also arguably give better evaluation mechanism.
Or democratize it, even perhaps if you're allowed to, there's a bigger world for you to sell your piece of the private credit to, and not necessarily be subject to that 5% per quarter redemption. So certainly a lot of potential there. When do you think that the world is really going to change, where you look at your Schwab statement, your Fidelity statement, whatever it is, and that's all your holdings? When is that going to really change, where you'll have that, and then you'll have sort of something else for like all your tokenized holdings? Is that 2026? Is it 2028? When do you think that we'll really start seeing that?
Yeah, that's a good question. I do think that the regulators are moving. I mean, this whole SEC thing where they're treating assets like a tokenized stock. It's a pilot that's happening in Q3 this year. It's only the Russell 1,000 to start. But I think the world of tokenization moves pretty quickly, and so I wouldn't be surprised. Like, let's say, like by 2030, right? I think is where at that point in time it's only 4 years out, 4.5, 3.5 years out, almost 4 years out, where at that point in time, some of your statements from Schwab or Fidelity and so on, and you own some tokenized stock, whatever, the report you get every month or every quarter will show your stock, and then it'll show you your tokenized. And I don't know whether or not they'll actually show it as a separate section or they just kind of blend it all in, right? So like, let's say if I own, Google shares, that's the regular stock kind, and the tokenized kind, where they'll actually have a slightly different a different representation on the report. But yeah, I think by 2030, if not even earlier, I should be able to see some of that from traditional large brokerage companies.
Yeah, who probably want to say, we want to, we still want people to sign into our platform, so we better aggregate all those things. That seems like
Exactly.
the way.
That's their value add. Is like you have the existing long relationship with the end retail customer, right? And then they want you, then you be able to transact all possible transactions through them. So they are still holding on to your assets. They're able still to, say you have a massive, assets under management and so on.
Makes sense. Makes sense. Tell me a little bit about Architect March, the organization that you're with now. What does it do? What does it offer?
Yeah, it's a great question. It was started by partners that were in merchant banking and also in a family office. And so basically, it's a set of relatively senior executives globally, but we're concentrated mostly in Asia Pacific. And it really kind of provides a set of services to really two groups of clients, family offices, and then also emerging growth companies, right? And so what we kind of say we provide value creation services, and that includes a mixture of consulting, advisory, business acceleration, connectivity, fundraising, business development. So across the whole life cycle of growth. Okay, so basically, what that means is like you'll say for a private entity that's looking to raise another second round, they might say, okay, Architect March, you have experience in this industry. Look at our idea for raising X millions of dollars. Give us some advice on how we should think about it. How do we develop the messaging? How do we maybe tweak certain things in terms of our proposal? We might talk to specific potential partners in terms of how we can improve their business. And then we can also help them raise funds through our network of family offices. Okay. On the flip side, you have family offices that have assets to invest. They want to find private investments in private companies in certain sectors, and maybe they don't have as much experience into certain sectors. But for example, a family office who don't have a lot of experience with AI data center infrastructure will say, well, now we know that's a hot area. We want to diversify our portfolio, and we want to make an investment in that area. So help us identify a really solid investment to consider, right? So we kind of provide that bridge between family offices and then the companies that are looking for financing.
Makes sense because you can't expect certain family offices to have all that expertise in house, which is what you provide, and you also sort of match the partners who are looking for funds and then people who are looking to invest. That makes a lot of sense. Finally, I want to, I know it was a little while ago, and without revealing any proprietary information, tell us about the experience of working at Google X. I mean, what was that like? And, what were some of the technologies that are now natural to us today that, were new then? And maybe from your point of view, what are some technologies that we should be thinking about that most people aren't thinking about right now?
Yeah, good question. If I look back at, through everything I worked on, that was my favorite role. Because traditionally in a role, we always think about how do we do things better. So that started when I was at Accenture. It's about how do we continuously improve. But then the Google X kind of mindset is actually very different. It's not trying to improve something 10%, 20%, but it's actually saying, let's start with a clean sheet of paper. Let's look at big problems in the world, problems that a billion people or more face. And let's just come up with crazy, crazy ideas, completely out of the box. And let's just brainstorm on some possible technologies, and let's really iterate on it and keep trying it, launch different prototypes, and then we'll see if we can solve it. So the idea of freeing yourself from looking at what has already been done in the past to just kind of look at revolutionary paradigm shift types of technologies was very exhilarating, right? So I focused a lot more those days working on energy. So we had a wind energy project, we had a solar energy technology, also worked on internet connectivity projects. We also at that point, I would say the most successful was the self-driving car, a concept. We had other things like, one project that I really would like to have worked on. But one of the things is that, we launch quickly, but we also kill ideas as quickly as we can as well, which is part of that innovation. There's a project that, I don't know if you watch Star Trek at all. I'm a big Star Trek fan. In that, there's a concept called the holodeck, right? Where you're immersed in a room and you're able to have your walls surrounded by a immersive experience. So one of the projects I was working on, I tried to pitch this to some of the top museums in Asia Pacific, which was imagine a room where now you could be, the visitors to the museum could be immersed in almost like teleported back in time to a specific, let's say if it's Chinese art, like back to the Ming Dynasty, where now you're in a scholar studio admiring the room, right? Like made up with the artwork, the paintings, the sculptures, the porcelain, everything, right? So you're really immersed into that experience. And so that was a wonderful technology that I wish, we could have brought to life. But then there were just some technical hurdles that we thought it would just not end up not being economical. So that project got shelved. But that was just an idea of a just amazing technology I wish that we had brought to life.
Meta tried to do that really with their sort of virtual reality or something, Ready Player One something. They put a lot of effort into it. I think, as you said, maybe you guys realized it faster that it was very expensive and might not pay out the way that they thought.
Yeah, I mean, for us, it was more like we're trying to literally put the whole room with these large screen, almost like TVs, but like different technology, where the bezel is so thin that you can't even notice it from a distance. So you're literally immersed in the room, and imagine that the walls and the ceiling, right, could totally project whatever. And so you could now be transported into back in the Ming Dynasty. I could be put on to the Mars, right? I could be put into a live concert. I could be put into any venue possible. So it is like surround sound, surround. So it's like the holodeck, except the fact that you can't physically touch the things, and you can't keep walking endlessly in the room. But the surrounding images and everything, like basically is all be controlled by computers. But yeah, I think it was just about making the bezels thin enough. I think that was the technical challenge.
So does that, do they still do that? Do they still do Google X in terms of looking for like moonshot stuff, or is that a little bit more now on the back burner?
No, Google X is still there. I mean, they launched some projects. One of the projects that they had launched, I think, got spun out as a public company recently. So back then, I was working on this technological project Loon, which are these balloons that fly overhead, provides 3G access below. And I think the teams, one of the real key advancements was putting lasers on top of these balloons, and you have a beam of lasers that could basically connect the two balloons and communicate, send signals to that. And they found a way to aim those lasers so precisely over very long distances that's like even like almost perfectly aligned. And so it's called free space optics. So I think that Google X recently spun off a company to continue to work on this area. Yeah, so I think Google is constantly launching new companies that work on various different technologies, and it's just very exciting to see whenever things launch out.
It's good to see that that people are taking a blank piece of paper and looking to solve issues, and and it may not, and you need a company that has deep enough pockets and enough vision to go ahead and do that and not worry about necessary next quarter's earnings or you spending too much. So that's good to know that that somebody is still doing that. Well, Josh, thank you so much for spending so much time with us today. Look forward to having you back on the show again.
All right, thank you so much, Ty. Have a good rest of your day.